I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service. Welcome back to the show, Ted.
Oh, it's good to be back, Jim.
How are people dealing with the markets over the summer? I know, of course, half of us were on vacation at any one time over the summer months, but is that making any difference on what's happening in the equity markets?
Well, certainly with a lot of people on holidays, the path of least resistance has been up, but we've got the American markets making new all-time highs almost daily. Our own Inc. Canadian Insider Index has been making 52-week highs, if not on a daily basis. Certainly every other day or so, it seems to be being able to put in a new high. So markets are inflating higher, and this is despite of warnings from people like Bill Gross, who at one time was the largest bond manager in the world, signaling that there's tougher times ahead. And the current bond king, I guess you could call him, Jeffrey Gundlach, who is, if not the manager of the largest bond funds in the world, certainly probably the largest actively managed, active bond manager. I think he came out with the sort of sell everything, nothing looks good a week or two back. But the market keeps going up, and our own indicators with the American insiders are also signaling a huge amount of caution. Our U.S. economic indicator, short-term indicators at multi-year lows, signaling multi-year levels of anxiety and taking money off the table. So, what's going on? Well, we've got a report coming out to our clients that's going to be published in just a couple of days, and it's titled, What's a Value Investor Like You Doing in a Market Like This? And certainly if you're a fundamental investor looking for companies that are underpriced, and you can have some reasonable assurance that you're going to get more cash flow out of that company than the amount of cash you have to plunk down for it now, you're just not going to find very many opportunities. So what does that leave you? It leaves you a market that's being driven by speculation, hype, algorithmic trading, and TINA. TINA being there is no alternative. And when you're a professional money manager and you see the market keep going up, you have a huge career risk if you're sitting in cash while your competitors ride the wave of momentum higher and higher. So that's what's going on. But I think given the giddiness I see in the market right now, basically people scoffing at these types of investors such as Gundlach and Gross, when you see sort of smaller players in the market trying to sort of build their careers on taking on some of these established and now probably more conservative oriented investors, I think we're probably nearing some sort of a peak in how shall we say, short-term gains now. That doesn't mean the market's going to collapse from here, but I'm not so sure how things can keep going without another little bit of correction, given all the risks that are out there.
Where is the money coming from then that's fueling the market?
Well, there's still people in the United States and Canada that contribute to pension plans, and in the U.S. they're called 401ks, and here sometimes they're called corporate RRSPs, defined contribution plans, and a lot of money gets put into the market every week or every month, and a lot of that's turned over to active managers who are assigned the role of managing these monies, and it gets back to the career risk. If they underperform their peers, they risk losing their assets under management and their paychecks. So the risk is a lot higher if the average investment manager is putting money into the stock market, Jim. You're taking a big risk if you don't follow suit. It's a lot better from a risk management, a career management perspective in the money management field. If you follow the herd into the market and just hope you can pick some better stocks, get a couple of percentage points better than your competitor, and you'll get more assets. But what you don't want to lose your assets. Even if you underperform your competitors a little bit, you're unlikely to lose all your assets. But if you underperform your competitors by a huge amount, by sitting in cash while the stock market goes up another 20% or so, then you could be in big career problems. So the path of least resistance by the other people's money management crowd is to invest despite the very lousy fundamentals, despite huge risks in the market. And if everything does turn south, then the big losers will be the investors, the people who put in money into their pension plans every month, because the active manager will say, well, yes, I've lost money, but so did everyone else, so there's no point in firing me. And that's what we're heading to into the fall. That's the table that's been set. We're not seeing economic fundamentals improve. Yes, I know we had a huge jobs number out of the U.S. that everyone's so excited about. It was boosted by a seasonal adjustment. These job surveys are just that. They're surveys in Canada. You can't take them. You have to look at a 3-month average in Canada. You can't look at them month by month. The U.S. is becoming very volatile. We're in an election year. I wouldn't put a lot of faith in those job reports. There's a lot of other data that's coming through very soft. This week we had terrible productivity numbers out of the United States, yet the stock market keeps going higher.
So it really is a classic case. There is no other place to put your money if you want to see it grow.
It's called dancing. It's called Dancing with Tina, and there is no alternative. And this is what professional money managers are doing. This is not a retail-driven. Your typical listener who's listening to this is not the one driving the stocks higher. This is not 2000. This is not cab drivers investing in tech stocks or gold stocks or whatever. This is professional managers. People who are paid a lot of money are driving this higher. Okay? It is people that your listeners pay to manage their money. These are the people who are driving this market higher. It is not the retail investor. So the proof will be in the pudding in the next few months when we move from low volume summer trading where you can push up the market by just putting in an order when there's not a lot of volume. We'll see what happens in September as we get closer to the U.S. election and as more hedge funds, activist managers come back from holidays who may be willing to bet against the flow. We will see what happens in September, and September and October can be very testy times for markets, particularly in an election year, but none of that seems to matter right now.
I was going to say, usually, traditionally, if we're going to see an upset in the markets, it's always in September or October, but last year proved to be an exception. It happened in late August. Could we be looking at the same thing here, where everything, to me, seems to be sped up by about 3 weeks?
Well, you make a good point, Jim, because people are aware of those relationships. So if you bank on, for example, nothing happening until September, well, guess what? Mr. Market surprises you, or Mrs. Market, depending on your preference, and it happens before you think it's going to happen. So right now, I really think we're looking at a bit of a random walk here in terms of what could happen. There's a lot of potential landmines out there, and eventually the market is going to step on one. Now, I've been talking about this for a couple of years because we go by our insider signals, and in the U.S. in particular, for years they've been signaling that this is not a value market. It's a market basically of momentum. And so what we had for a couple of years anyways, we had the U.S. market go sideways to sort of try and let earnings catch up. And yet now it's moving ahead again, even as earnings continue to fall, and even as productivity continues to fall. So things are getting worse in terms of the fundamentals. They're not getting any better. And yet you've got this narrative, the Fed is saying, well, the economy is doing fine, we're going to raise rates, but just not yet. And you do have a lot of people in the mainstream media who repeat that mantra for one reason or another. And it does lull a lot of people into a sense of complacency. And we're clearly at a very complacent point in the market right now. The volatility as measured by the options markets is back. It's almost down to single digits. Usually, you would expect it to be somewhere in the mid-teens. But when it gets down to 10% or less, you're really into an abnormal quietness. And those are often it's often the calm before the storm. So why am I sounding the sort of the alarm bell here? Just because risk is underpriced, and I think that if anything, what you can do, if you do believe that the market's going to keep going higher, and there's a lot of good reasons to believe that with respect to liquidity, not fundamentals, but liquidity, then it's relatively cheap to insure by investing in put options or option strategies that are right now relatively cheap. You don't want to start doing, unless you're a professional options trader, you don't want to start doing those kind of strategies when the market's going crazy, either on the upside or the downside. It's usually then very expensive. Where you can put on insurance is during periods like this where it's relatively cheap, and if you lose money on the insurance, you'll be making money as stocks continue to march higher as they've been doing the last few months.
We'll have more with Ted Dixon right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Ted Dixon. Ted, in a world where so many places like Japan and Europe have negative interest rates, you really are being squeezed into a corner if you want to make any money. But my question is, who are these people buying bonds that in 10 years will give you less money than you put in today?
I can tell you who are buying those bonds. These are fiduciaries of institutions like endowments who are scared to death of investing in something that could go bust or bankrupt. And so if you're on the board of an endowment, you've got a real predicament. You've got to, first of all, try and generate enough income to fund your organization. So an endowment usually uses income to pay the salaries of its nonprofit employees. For example, if you're a university or even a sort of a community-based service provider, if you're supported by an endowment, you use that money to run your organization. Now that's what in normal times you would look for the income to do that. But if you lose the endowment money, if it blows up, then it's not a question of paying salaries, it's a question of survival. So a lot of endowment money, they're just hoping to keep their capital for a better day, and they have to set a lot of it aside. Now, I mean, I myself have sat on a non-charitable board, and it's been a real scramble to find safe investments to keep the organization's money, because you can only put so much into guaranteed insured certificates of deposit, and then you've got to start looking at government bonds. And in Canada, thankfully, they still pay some interest, although I'm afraid that Stephen Poloz is going to try and bring negative interest rates. Stephen Poloz is a believer that, the lower the Canadian dollar goes, the better off everyone is, which is completely wrong and ridiculous, but that's his modus operandi, and we're stuck with that. So I'm very fearful for Canada in terms of the next moves that the Bank of Canada is going to make. I hope I'm wrong. I hope they come out and say they're not going to do negative rates. But there are organizations and people who need to invest in low risk assets. That is the way it's always been. That's the way free market economies work. You need a broad range of assets, not just risky assets. And central banks are trying to make a shortage of safe assets. Well, that's going to end in a lot of problems down the road when you force a lot of people who need safety into either negative yielding instruments, or you force them into risky assets that they don't understand. So this is not going to work out well at some point. I would argue it's not working out well right now, because we have very low growth. We've been into these experimental monetary policies now for almost a decade, and look where it's got us. We have collapsing productivity in the United States. We have an economy in Canada that gets blown up but first by the energy sector, and may very well get blown up in a couple of years by a real estate sector. This is the new Canadian economy. It's a barbell economy between energy and real estate, and there's not a lot in between, unfortunately. And this is a real shame, and we can talk about this on another show. But, we've got a huge amount of human capital in this country, yet Stephen Poloz is trying to drive these people into other countries, by devaluing the currency in Canada. He's essentially driving our best and brightest who are graduating from university into the United States and into other jurisdictions that have higher growth prospects. So it's really discouraging, the path that we're on. Now we have a new government, and they've been in power now for just under a year. They've made some, I would say, decent moves, but they've now got to explain how they're going to diversify our economy through the right policies. And I hope it's not through Kathleen Wynne-style government intervention in the economy, because that doesn't seem to be working out too well in Ontario either.
Yes, where Ontario Hydro has lost billions and billions, putting their customers on the hook for, I don't know what, $8,000 a piece or something.
Well, and we're just not seeing the kind of manufacturing revival that either Kathleen Wynne or Stephen Poloz, have been promising. And these are both very activist type policymakers. Stephen Poloz, who was appointed by the Conservatives, believes that he can set interest rates better than the market, and that he believes that through his policy he's going to stoke a manufacturing revival. Well, what he stoked is a real estate revival. And what he also stoked was a recession in Alberta when he eased monetary policy too early in 2013. So those are his major accomplishments. And for Ontario, it would take a whole show to kind of list off what Kathleen Wynne has done in Ontario.
Could Trudeau fire Poloz, or does he have an ironclad contract?
It would be hard. You'd have to do it. There are ways of arranging outcomes, but no, he cannot be fired. But he could certainly be, provided other opportunities that he couldn't resist. But I don't see that coming. I think the federal government has other, they have a lot on their plate, and at this point, I don't see picking a fight with the Bank of Canada as something that at this point would be high on their list. As a matter of fact, I don't see it on their list at all.
Ted, I take it you're not a big fan of central banks.
Well, if you could point to me, Jim, to a central bank that's managed to operate with some degree of success over the past 5 years, then I'm all ears. But I look around and I believe they've worn out their welcome. Yes, they did perform a very valuable function in the financial crisis. Unfortunately, the Fed was partly responsible for the financial crisis, so it was kind of they fixed up their own mess. But I think we need a new model for central banks, Jim. We need to make them more accountable. Back in the 1980s, when there was a huge inflation problem, it was a different era, and yes, central bank independence was required at that point, but now they're picking winners and losers in the economy. They're favoring debtors over savers. They're favoring exporters of resources over exporters of information technology and services. They're doing all sorts of activist types of functions in the economy, which really require a higher degree of oversight and accountability that is currently there, particularly in Canada.
Too much of a free rein and not enough rangers to watch over.
Well, our political system has just not been designed for the modern technological era. We've got a very rapidly changing networked economy. And to expect that the central bank can be held accountable by going up to Parliament Hill every 6 months or so, and answering questions from politicians who have a million things on their plate. Most of them are lawyers, not schooled in economics, and individual MPs don't have a lot of resources to brush up on these files. It's not working. And so hopefully there will be some attention paid to improving the governance of the central bank in Canada. It's a big challenge, because you don't want opportunistic political interference with the central bank, but you do need a higher degree of accountability that's currently there.
Ted, thank you so much for chatting with us.
It's great to be here, Jim.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca, Canada's first online financial news and research service. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Questions can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.